Hello, team. This evening we're going to talk about Schedule C, when, and the very basics on how to do them. So, the Schedule C is going to be the most common business tax form that you'll work with this early in your tax career. Your people who will need them the most are yours that are independent contractors, small business owners, those who get 1099 miscellaneouses, maybe for doing side jobs, those who have side hustles, and those who have sole LLCs. Type of client, for example, would be a barber, a stylist, a braider, DoorDash driver, Uber driver, rappers, strippers, any type of artist that does gigs at the different clubs. Those type of people would also file a Schedule C. Let's take a look at a Schedule C. This is Schedule C. Of course, you know the basic information that would go here. You're going to always select the appropriate accounting method that they use. You'll answer these, which you'll find out that information during your interview of your client. Here, you will make sure that you use their gross sales or weight or income that has come in. That is the amount without the expenses taken out. This information can come from a variety of places. They may have a 1099. They might have a 1099 and some bank statements. They may have a 1099 and some receipts in a shoebox. They may have a receipt book. They may have their Square um, register quarterly or annual printouts. This information can come from many places, but you want to make sure that this line does not have the expenses taken away. For your customers that have restaurants, stores, boutiques, even online stores, this line is important because if they've had returns, someone sent them back the product because it was damaged, too small, too big, that amount, the value of that amount goes here. Cost of goods sold. If you have a restaurant or a store of any type that has inventory, this information on the sheet, you just see the sheet and you have to figure it and put it in there. In the software, it will give you an area to put in the information of the beginning inventory, the amount of returns or allowances they had, and the ending inventory that would go on this line. In this area, you have your expenses. There's a few expenses I want to touch on really quickly because even though it appears self-explanatory, you want to make sure that you are utilizing these areas correctly. So, of course, you know advertising, your business card, your flyers, your banners, your posters, your Facebook ads, your Instagram ads, your TV or radio commercials, your billboards, your branded clothing items, hats, t-shirts, etc. All of this is considered advertising. Commissions and fees. If you sell a product in which you pay someone a commission for sales. Contract labor is for people that were independent contractors that were paid, people that were not paid a regular payroll check with taxes, etc. coming in. So if they had people who came and helped them work for their business and they just paid them cash, here's where this will go. Legal and professional services, attorney, accountant, coach. These things are claimed here. According to the IRS, you cannot claim the filing of your income taxes. Wages. Wages are for any employees they have that were paid normal payroll where taxes are taken out. The employment credits that you're deducting is if they had any federal credits applied, welfare to work credits, um, reentry of a convicted felon credits, employee and a veteran credits, things of that nature. Okay. So keep that in mind. In the software, it's going to look a little different, but there will be an option that says if they want to claim the use of their home. Okay, there is a worksheet if you're doing it manually in the software to ask you the questions. If you're going to simplify, the most you can claim is 300 square feet. You want to be careful when filing the Schedule C that you get all of the information in as correctly and accurately as possible. Here's the other thing. You hear a lot of preparers say, write them all the way off so they don't know. Write them all the way off so they don't know. Write them all the way off so they don't know. Do not write them all the way off so they don't owe. Because if you write them all the way off so that they don't owe for 3 years, if they take a loss, they make $0 for 3 years, the IRS will no longer consider them a business. They will consider them a hobby because businesses at some point at least break even. So be very careful in the questions that you're asking and how you're handling a person's business expenses in an effort to avoid the payment of taxes. You may cause them to not be identified as a business anymore. So make sure that you're asking these questions. As you see on the screen now, cost of goods sold. Cost of goods sold, you'll see in the software, it's going to ask you what were your methods for inventory? What were their methods? What was the beginning? What was the ending? You know, it's going to ask you this information to help you figure out. Now, some of your customers may not have done inventory. If they did not do inventory, then you can't claim the inventory. It's just that simple. If they didn't use inventory, then you can't claim. So this is just a quick tip on the basics for your Schedule C. Remember, you have to have a Schedule C due diligence turned in. So you're going to want to make sure that you ask all the questions that you can so that you're not later fined for something that you overlooked. Thanks for tuning in. If there's any detailed questions, please message me direct. Have an amazing evening.